The U.S. has had an impressive rally in the prices of Treasury securities. The 10-year U.S. Treasury has seen its yield move from a recent high of 3.23% in early October 2018 down to 2.22% at the end of May 2019. Is the Treasury rally signaling that a U.S. recession is imminent? While we see U.S. real GDP decelerating into the second half of 2019, we do not yet see the U.S. moving into an actual recession anytime in the near future. If that read is correct, then what is driving the U.S. bond market rally? Well, there are a variety of possible interpretations as to why the Treasury rally has been so powerful. 1. Subdued path of inflation. Persistent core inflation below 2% has led to inflation expectations being anchored at a low level and to market participants having increased confidence that inflation pressures are not likely to reemerge. This is reflected in lower yields on U.S. Treasury notes and bonds. 2. Influence of Germany and Japan government bond yields. Due to aggressive asset purchases, the European Central Bank and the Bank of Japan have driven the yields on their 10-year government bonds to near zero and occasionally just below zero. These markets compete with U.S. Treasuries among global fixed income market participants. Even with a little foreign exchange risk, the zero yields from Germany and Japan exert a downward competitive influence on U.S. Treasury yields. 3. The lose-lose trade war has yet to panic U.S. equities. The U.S.-China trade war has escalated materially in the last month, leading many to see it as a lose-lose situation for global trade and economic growth. The heightened trade war tensions capped a rally in U.S. equities, but the sell-off is nothing like the panic in Q4 2018 when equities lost almost 20% in a very short time frame. Even so, there has been a flight to quality in this risk-off environment. 4. Unusually twisted shape of the U.S. yield curve. Flat or inverted yield curves are a consistently good predictor of increased equity volatility and weaker economic growth some 12 to 14 months down the road. Now, though, the yield curve is inverted only on the front end, resuming a modestly positive shape from the 5-year maturity through to 30 years. Our interpretation is that the yield curve is signaling the potential for equity volatility, actually that's already arrived, as well as indicating a risk of deceleration of real GDP growth, but it's not signaling an outright recession. Remember, the Fed is data dependent. Data dependency means that the Fed will not act in anticipation of a recession that may or may not happen. Even if the Fed is worried about a trade war, the yield curve, a debt ceiling crisis, whatever. The data the Fed will be seeing prior to its next few FOMC meetings argue against any rate cuts yet. The economic expansion is about to pass the 1990s as the longest on record. Unemployment is below 4%. Inflation is subdued but not nearly low enough to convince the Fed hawks to switch to a dove vote. I'm Blue Putnam, Chief Economist, CME Group.